Hi friends, welcome back for another video. Today we will be discussing asset allocations. I will start off by presenting this conversation. Hey PP, I just sold my GME and profited $200. Congrats, nice profits. Now I'm thinking where to put my money. Why don't you put the money in your other investment? I don't have any other investments. Where do you put your money then? Bank account. Actually, the thing I want to stress out in this video is not about investing in GME or any other stocks. Let's look at two more examples. In this example, on the left hand side, I'm showing a bank account, and on the right hand side, I'm showing the stock investing. So a friend just bought 20 shares of Apple at $110. Then the share price of Apple went up to $132. And the friend looking at the share price increase and is very happy and asking himself, should I sell at 130? The next example, a friend bought 20 shares of Alibaba at $270. However, he is not so lucky and the share price dropped. And he is asking himself, should I cut loss and just sell at 225? In these three examples, if you realize, our dear friend is constantly asking himself whether he should buy or sell. When the share price goes up, he's asking whether he should take profit. When the share price drops, he's thinking whether he should cut loss. So he is constantly asking himself whether he should trade the stocks in and out. In my observations, many people investing in the stock market behave this way. There's no right and wrong by investing this way, it's just that I'm thinking this type of mindset is more appropriate for trading and not really for long-term investing. Let's take a detailed look. So in this example, our dear friend has a bank account and he has made a couple of investing in the stock market. In the yellow box here, this is how most people see their investment. So the question is, what is the role of bank account? Is it a war chest? Emergency funds? Is this not an investment? In our financial journey, we start out by owning no assets. And the goal towards financial independence is by owning a lot of assets. So back to this example, what are we maximizing? We are not maximizing the stock investment. We are also not maximizing the bank account. But we are maximizing the total assets. In fact, the total assets will include other investments such as houses, bonds, and also commodities. So the strategy to manage all these different asset classes is known as asset allocation. Let's go into some details here. In general, there are 5 different types of asset classes: cash, fixed income, equity, real estate, and commodities. Example of cash is current account, fixed deposit, Singlife saving, etc. Cash is the asset class with highest optionality. It is liquid and you can use it to buy anything. Keeping cash is also important from psychological perspective because market correction will occur from time to time. Market crash is not so scary if you still have cash to deploy. The scariest thing is market crash and you don't have any cash to take advantage. Next one is fixed income. This asset class is huge but mostly only accessible by institutional investor. There are fixed income that retail investor can buy, for example the Astria retail bonds and Capital Mall bonds. Besides that, government bonds like Singapore Saving Bond can also be invested by retail investors. Bonds is essentially lending money to someone. The institution who issued the bonds are the borrowers, bondholders are the lenders. Because you only lend money to someone, the return is only the interest rate. There's no further upside from that. We all know that interest rate is very low now, so if your investment are focusing on cash and fixed income, then the return will be very low. The next one is equity. Equity includes stock investing, ETF, equity mutual funds, and so on. Equity investment is essentially ownership into the business. Because you own the business, you get to participate in all the upside of the company's growth. There are 2 types of equities, public equities and private equity. Public equity are businesses that are publicly listed on exchange. Private equity are those not listed, hence typically not easily accessible by retail investor. If you set up your own company, that is also considered as private equity. Next one is real estate. Real estate represents ownership of physical space such as houses, shops, and REITs. The full name of REITs is Real Estate Investment Trust. REITs is a collective investment scheme that pool investor money and invest in portfolio of income-generating real estate assets such as shopping malls, office, hotels, or service apartments. Lastly, we have commodities, which represent ownership of goods which has an end use. Example include precious metal like gold and silver, and cryptocurrencies such as Bitcoin and Ethereum. So a strategy asset allocation is basically to determine the allocation into each of these asset classes. The next question is, what do we need to consider in setting our asset allocation? First is time horizon. Are you investing for the short term or long term? For example, if you are saving money to buy a house, it is not recommended to put your money in stock market due to its large volatility. If you have a long time horizon, say for example you are investing for retirement, then putting money in an asset class that have high long-term return such as equities would make sense. Next, expected return. Every asset class will have different expected return. Equities historically earn 10% per year, whereas bonds have much lower returns. The returns that we can get from bonds depends on the interest rate level at the time. For example, nowadays interest rate is very low, even Singlife has cut the interest rate to 1.5%. Next consideration is risk appetite. How much losses can you tolerate? If you can only tolerate small losses, then go for safer assets like cash and bond. If you can tolerate higher risk, you can invest in equities and REITs. If you have an extremely large appetite, then you can invest in asset class that can potentially give you even higher returns such as cryptocurrency. Next one is income. You need to know the nature of your active income. For example, if you are stockbrokers and your income is heavily depending on the stock market performance, it is not recommended that you put a lot of money in the stock market. This is to avoid the situation where you lose your active income and your stock holdings collapse at the same time. If your active income is not correlated or negatively correlated with the market, then it is okay to be more aggressive in your investing. So example of negative correlation is if you are bankruptcy lawyers. Your active income is doing even better when the economy and market is performing poorly. Next one is expenses. This is the most important variable of personal finance. If you live within your means, then you will have more free cash flow to be invested, which will allow you to be more aggressive in your investing. The last one is your current financial situation. Everyone's situation is unique. For example, if you are going to purchase a house soon, you will invest differently. If you have to support young children and the education fee is not cheap, then you will invest differently compared to someone without dependence. In summary, you need to understand your current financial condition and make the decisions that suit you. Let's go back to the previous slide. So we'll go into more details on the equities. Here I want you to see the stock investment as an asset class, and the performance of the asset class is basically the aggregate performance of all stocks, or simply the average returns. And we will leave the stock selection or stock picking discussion for another video. I'll be sharing a couple of charts that I took from Credit Suisse Global Investment Returns Yearbook. The first chart here is showing the relative sizes of the world stock markets. The pie chart on the left hand side is showing the breakdown of the stock market as of end of 1899, and the right hand side is as of 2020. 110 years ago, UK has the largest stock market, followed by US and Germany. Fast forward to 2020, slightly more than half of the stock market cap is in US, followed by Japan, UK, and China. China's stock market currently is very small, at about 4%, and their stock market history is much shorter compared to the Western countries. So the next chart is showing the cumulative returns on US asset classes in nominal terms on the left-hand side and real terms on the right-hand side. So the real terms is after the adjustment of inflation. As you can see, in the past century, the equities has performed very well with 9.6% return per year. Even after we adjust for the inflations, the real returns is at 6.5%. Bond returns at 4.9% and bills return at 3.7%. This is only slightly higher than the inflation at 2.9%. Next slide. The table is showing the real equity and bond returns in selected markets. So the equity returns of United States is higher than world average, but other markets such as Europe, Japan, Switzerland, UK are not that different. The next thing I want to highlight is the minimum returns. I've heard people say this quite often. If you invest in S&P 500 because it is very diversified, so the risk is very low. Actually, this is not true. As you can see in this column, when there's financial crisis, the stock market can crash by 40% in a single calendar year. For example, the world stock market dropped by average of 41.5% in 2008, and the UK stock market dropped by 56.6% in 1974. It is important to know that even though stock could potentially give us a very good returns, but the volatility is very high. So we need to set the expectation right. This chart is showing the real annualized equity returns in local currency and US dollar from 1900 to 2019. The average return for each country is different, but they generally range between 3% to about 7%. That's all about the overview on the asset classes and the stock investment. Let's hear another conversations. Hey PP, I want to invest in equity asset class. Sounds good. How can I do that? You can buy ETFs. Which ETFs? I would recommend VT, SPY, and QQQ. I understand that not everyone is interested to pick their own stocks, but even if you are not interested, it doesn't mean that you should stay away from the stock market entirely. One way to get exposure in the stock market without stock picking is actually using ETFs. Let's take a quick look on these 3 ETF. The first ETF that I mentioned is VT, which is issued by Vanguard. VT tracks the performance of the FTSE Global All Cap Index. It is passively managed, hence the expense ratio is very low at only 0.08%. So this ETF gives us a broad exposure across developed and emerging equity markets around the world, including the United States. It includes approximately 8,000 holdings in over 47 countries. Let's take a look at the performance history. The performance in 2020 is 16.74% and the performance since inception is 7.41%. The inception date is 2008. This ETF will cover the entire world. The allocation to US is 56.6%, Japan 7.2%, China 4.8%, and so on. The 10 largest holdings and percentage of total net assets is shown here. So you can see there are US companies, Taiwan companies, and also China companies. This ETF is extremely diversified. The top 10 companies as percentage of total net assets is only 13.7%. Let's move on to the next one. SPY or SPDR S&P 500 ETF Trust. So this ETF only covers US companies. S&P 500 Index is a diversified large cap US index that holds companies across all 11 GICS sectors. The top 10 holdings are quite similar to the VT ETF, but you don't see companies that's outside of US here. So the annualized returns in the past 10 years is 13.74%, which is not bad. And the gross expense ratio is only at 9.45 basis point. So this is a very good ETF if you only want to focus on the US companies. The next one is Invesco QQQ Trust. QQQ track Nasdaq 100 index. So the index includes 100 of the largest domestic and international non-financial companies listed on the Nasdaq stock market based on market capitalization. So there are only 102 holdings, which is more concentrated compared to VT and also SPY. The total expense ratio is slightly higher at 20 basis points. If we look at the performance in 2020, it generated 48.63%, which is very high. This is because if you look at the holdings, most of them are actually tech companies. So that's all about today's video. Hope you like it. See you in the next one. Cheers!